Hello ladies and gentlemen, today we are discussing the difference between day trading and options. I'm going to go over 3 benefits of options, 3 disadvantages of options. I'm also going to be going over 3 benefits of day trading and 3 disadvantages of day trading. First, we're going to go ahead and get into the 3 pros of day trading. 1, you can pick any position you want, any size. You can pick 195 shares, you can pick 203 shares, you can pick 46 shares, it doesn't matter. 2, when you're day trading, your position is rather liquid. You can buy and sell at any point in time, any part of that position that you want. It doesn't have to be the whole position. You can sell half the position, you can sell 75% of the position, you can sell 3% of the position. There's no difference. You can day trade any part of that you want, in any way that you want. For example, you buy a position in Apple at, let's say, $100 a share. It goes up to $105 a share. You sell 30% of the position. It goes up to $110 a share. You sell another 30% of the position. And then you see it coming back down to $100 a share. You liquidate the rest of your position and you don't lose anything. That's a day trade. The third advantage of day trading is you can liquidate the position without losing much. Let's go with Apple again. For example, let's say Apple stock is $100 a share. You buy it, you're hoping for Apple to go up in value. Seems like there's some really good news that's ready to come out, and all of a sudden you're buying Apple shares. You expect it to go up to 105, 106, 107, $110. I don't know. You expect a 10% profit in one day. Turns out that good news didn't work out, and what happened instead is your price for Apple actually went down. You can sell that at $99.99. You've only lost 1 cent. That's possible. Let's go into the 3 disadvantages of day trading. Number 1, you must have an account size of at least $25,000 in order to do day trades. If your account is smaller than $25,000, then what you're going to end up doing is you're going to find out that you're limited to 3 day trades a week. That's not a lot. You have to be very confident in your positions in order to achieve success, and you're going to be very limited to what you're trying to do. It's not going to be a walk in the park. You can't buy and sell at every change in the price unless you're over $25,000. Number 2 for day trading is if you are trying to day trade, what you're going to find out is that you have a limited opportunity for growth. Most stocks, most positions, most reputable stocks, most reputable positions don't change more than maybe 2-3% a day. If there's something amazing going on, maybe 10%, maybe 15%. If there's something out of this world, incredibly good happening, then maybe 20% in one day. If you're day trading, you probably won't get the full 20%, 10% in the best case scenario. And if you're day trading, you're probably not going to end up even getting more than 20%, even if you did do the full the full profit of the day. The third disadvantage of day trading is simple. You are sometimes trapped. There is information out there that because you're focused on the moment, the instant, the second, that you don't end up observing the larger picture. You're a small fish in a huge ocean and there's a whale passing by and you don't notice it because you're trying to eat some algae. You might buy Apple stock expecting it to go up to 105 and you expect to make a 5% profit in one day. When there's other areas in the market, if you had checked, you would notice that there's a very strong consensus that Apple is actually going to be going down. And you didn't know that because what you were interested in is in the day trade, and in the day trade, that's not really something that's usually available to you to notice. You need to be aware of advanced areas, advanced platform situations, advanced strategies in order to successfully be able to determine that yes, Apple will go up today, and yes, I will be able to successfully execute this trade and not lose money. With day trading, there's gaps in your information. You're gonna need to go beyond your basic day trading. You're gonna need to look at a lot more information to have a complete picture to be able to enter and exit a position successfully. Let's go over options. 101 basics, but we'll be going into some more detail with pros and cons. Number one positive for options is that you can achieve outsized gains. You can achieve more than 20% if you were to correctly understand how to do the position. If we go back to the Apple example, if Apple is at $100 a share and you expect Apple to go to $120 a share, you can pick an option that says, I believe Apple will go up by a few dollars in a very short time frame. You will be spending very little money, and if Apple does what you think it will do, you can have results that give you thousands of percent in return. Number two, your broker usually has better feedback and better information about what's going on with the stock. For example, if you're looking into the options, you're already in a more advanced stage. So this is required. If you were to try to do day trades without knowing options, you're at an extreme disadvantage. You can see that, oh, there's no demand for this option. There's no competition. There's nobody else in this area, in this stock, that's looking to buy this specific option. Maybe, even though I believe something is going to happen, there's nobody else for me to compete with. Therefore, that option might not be the best strategy to go into. That's going to give you the best results. Your broker helps you out with that quite a bit by letting you know, hey, you know, in this specific stock, let's talk about maybe IVR. It's a real estate REIT stock. You'll look into the options and you'll see, okay, there's one that's 2 weeks out, one that's a month out, and one that's maybe 3 months out, and the last one is 6 months out. There's no options that are a year out, 2 years out, 3 years out. It doesn't exist. And you'll see that the options for this specific stock are very cheap. And once you go in to purchase the option, you'll see that there isn't very many buyers, there isn't very many sellers. It's not an active stock that a lot of people are trying to pull into or sell out of. So once you see the level of competition, the level of intensity of the level of demand for this, you can make a better educated decision as to whether or not you want to enter that position. If you were to try to do the same thing with a day trade, there's nobody that's going to tell you that, hey, there's not much happening in this area. With a day trade, you might generate the selling or buying volume, but in the options, if there's other people competing with you, then you know that you're in a good place, because in the options world, a good idea doesn't just get lost. There's a lot of people that are looking into it and that are very interested in also trying to fulfill the same kind of results that you're trying to achieve. The third positive for options, real quick, 101, just the basics, is with options you can get very creative. Options are the situation where somebody is always describing on the internet, where if the stock doesn't go up or down, it just stays flat and you still make money. That's a very common strategy. That's something that you can learn to do. And it's something you can do easily and something that you can make money at on a long-term basis. I can even go ahead and make a video explaining how to do this in another video. Just go ahead and subscribe. I'm sure I'm going to be making that very soon. Let's go into the 3 negatives for options. Number one, this number one should make up for all of the other negatives for options. Almost all options contracts end up in zero. Almost all options contracts end up in zero. This is not to be taken as a joke. Almost all options contracts end up in a zero. When you were in school, I believe they said if the teacher repeats something several times, then it's important. Well, I just repeated that 3 times. Is that important? Absolutely yes. Do not ignore that. Almost all options end up in zero. Do not joke yourself. Do not kid yourself. This is an extremely large risk. Number 2 negatives in options. Let's say you do have an option that hasn't ended up in zero. You might be stuck with it. It might be very difficult for you to sell it, and it might lead you to zero. Options are not liquid. They're not like stocks. It takes significant more effort to sell it. When I say more effort, I don't mean more like you pushing a button on your keyboard or on your phone. What I'm talking about is you dropping the price, you lowering your expectation, you lowering your return, so that you can meet the buyer in a place where the buyer is willing to buy it from you. And if an option is going badly or poorly, you may end up losing 100% of your money in absolutely almost every case where we're making the bad call. In an option situation, you must mandatory limit your size, limit your position, so that if you do lose, you do not lose a lot. It's incredible as to how much you can lose in an option. Options can get extremely crazy, extremely complicated, and extremely complex. They can give you extreme rewards, but they can also almost always lead to zeros at the end. You need to know what you're doing with options so that you don't lead to zeros. But that should not stop you. That you should not be afraid of options because of that. There's ways to get around that. The final thing I wanted to talk about in terms of options is, even if you're making a profit, you're most likely not going to be able to get the profit that you thought you were getting. Let's say you put in $100 into an options contract and it's gone up in value to $200. Now your broker says your contract is worth $200, but there's a 20-cent spread. That means the people who are willing to sell the contract are trying to get $2.10, but the people who are trying to buy the contract are only willing to pay $1.90 or $190. That means if you want to sell your contract right now at this exact moment, you have to drop the price by $10 so that you can have that sale. You thought you were going to make a $100 profit, but you're only making a $90 profit because nobody's willing to produce that extra $10 for you to make that profit. You have to wait for somebody else to come along and say, yes, I will give you your full profit, because at this point, if you waited, that means the stock price went up more, and you could have probably sold your contract for more, but again, you would have to wait for the buyer to meet you where you are instead of you going to the buyer. So options contracts are sticky. You cannot always just liquidate and get in and out that quickly. If you want to, you have to pay a price. You have to pay the spread. And when you pay the spread, it can be a massive spread at times. A 20-cent spread or a $20 spread is not that much, but sometimes in options there's spreads of hundreds of dollars. I can't really tell you how incredibly insane that is. If an options contract has a spread of over $100, this has to be an extremely intense situation where people are in absolute chaotic positions about what's going to happen with a stock. We're talking about maybe like a Tesla or an Amazon, where somebody is trying to figure out whether it's worth paying that much for that, or somebody is trying to figure out if there is no way that contract should be worth anywhere near that. That means there's confusion in the market. If you're in the market and you're seeing option spreads that are close to $100, when I say $100, I'm talking about an actual $100 spread. This is going to be maybe once in a lifetime type of situation. If you see something like that, you want to maybe step back and reconsider whether you want to be in the boat. Because if you buy an option contract at that point, if you decide instantly to sell that same option contract, you are out $1,000. I'm sorry, that's a $10 spread. A $100 spread is a $10,000 loss. That's not something that's easily absorbable. You don't want to be in a position where just because you click the keyboard button or on a mouse or you touch your screen on your phone, now you're out $10,000 from an instant. You cannot day trade. Options are usually maybe something that you might want to swing trade. And even then, I don't think that's a good idea to go ahead and get into that if that's what your intention is. I'm going to give you an example of an option trade that's gone bad and an option trade that could have gone really good. This is from my own personal example, my own personal experience. This last week, I was in the conference calls for Wynn Resorts, Las Vegas Wynn, and then there's Shanghai. Anyway, they're casinos. The stock is at the $80 marker. The stock has been up to $150 and has been as low as $45. So it's somewhere in the middle. I bought an option contract on Thursday before the earnings call, and the option contract expired on Friday. Because I bought the contract before the earnings call, I had to pay 80 cents or $80 for each contract. I bought 5 contracts, that was $400. I was expecting the stock to go up to maybe $100 a share because earnings were going to be good. There's a virus, earnings are not good, people are not in the casinos. obviously. Anyway, I limited my position to $400 because in my portfolio, that's not a whole lot of money. So the earnings happened. It was very bad. The stock was supposed to go down significantly. It did not go down significantly. It only went down a little bit. But the next day, anybody else who was interested in that option the day before is no longer interested. And the option is going to expire in 1 day as worthless. So that means nobody else can buy that option. It's out of the money. It's literally worthless. In this exact situation, what I ended up doing is I sold the option for 2 cents, and I had just paid 80 cents the day before. So that's a loss of 97.5% in 1 day. When I had gone into this option, I knew that that was the risk. I knew that there was a chance of me losing 100% of the money, and I'm glad that I only lost 97.5% because it could have been 100 if nobody had purchased that option from me. I don't know who purchased it and why somebody would be willing to purchase that option from me, but somebody did, and they lost 100% of their money because that option ended up being worthless at the end of the day. That was insane. That was incredible. I don't know why somebody would buy something worthless for any money. Buying an option contract from me for 2 cents, a 2-cent option contract is worth $2. So why? I don't understand it. On the same exact day that I bought the options contract for Wynn, we had earnings on another stock that's known as Square. Square did what I was hoping Wynn would do. Square blew the earnings call out of the water. Square stock was up massively. If I had options in Square, I would have probably bought it for that same 80 cents. And if the stock had gone above the price that I had wanted to buy it at, above my call for the contract, then anything above that would have been converted to intrinsic value, and I would have been able to cash that out. I would have probably been at a loss. Let's say Square stock is $200 a share, and I bought a contract for $195. And let's say before the earnings call, it was at $175. These are hypothetical, even though the real event did happen just recently. I'm just not going to go ahead and pull that up for you guys right now. It's a hypothetical situation that we're talking about. So it was $175. If I had bet that it would be $195 and I had paid 80 cents for that, that means I'm risking $80 to have a result of all of the benefit of that stock as if I had purchased 100 shares. Imagine buying 100 shares of Square at $175 each. That's $17,500 where I only spent $80. And if Square stock had gone up to $200 a share in this situation, I would have netted $5 on an option contract that I paid 80 cents for. I could have sold the Square contract for maybe not the full $5 that I had earned, but let's say $4.80, which would have been a 600% return on investment, even though it was only a 1-day contract. Something like this is absolutely risky. It's not something that I recommend. This is not how I do options. This is a gamble. It's a gamble the same way day trading is a gamble because you don't know what's going to happen. You don't have all of the information. There's no way you can control the outcome of the stock market unless you have so many options, so many other points of pressure and influence, so much money invested in that specific stock that you yourself are absolutely controlling the entire situation. Please submit a like, a comment. I would appreciate a subscription. I'm sure if I continue explaining options in a normal, non-hyped up way, it would be very easy to understand. Options are very good. Day trading is not something that I recommend, and I can show you how to go into options and get yourself into a situation that makes you very happy. I hope to see you guys next time. Bye.